Hello class, this is Dr. Fenton. In this video, I'd like to review the content of Chapter 1 by covering the PowerPoint slides. Now what I've done is selected what I thought are the most important slides from the full set the publisher provides. The publisher provided about 52 slides for this chapter, and I thought that's a little bit too much to try to cover in a video. So I reviewed and just listed here the 18 slides I thought were the most important ones for us to know. So let's get started. This course talks about financial accounting. Now the second course you'll have in accounting, at the sophomore level, will be managerial accounting, but this one concentrates on financial accounting. And what people usually say is this is information provided for external users. That's true, but also financial accounting is used by internal users, such as the owners and management of the company. Now, as you study Chapter 1, and also really the rest of the course, try to think about what financial accounting information is doing for us. First, it's trying to measure the business activity of the corporation. Are we making a profit or a loss for the period? How much in total assets do we have? Things like that. And number two, we're trying to communicate information to the people who need it. For example, managers need to know about information in the company to help make the best decisions. And potential stockholders, investors, and lenders would like to know about the company to decide whether to purchase stock in the company or loan money to the company. One of the main things you need to remember throughout the course is this accounting equation. At all times, for every transaction, the assets will always equal the liabilities and stockholders' equity of the company. So don't forget this equation here. Assets will always equal liabilities and stockholders' equity. Now assets, what are these? These are resources owned by the company. These can be used by the company in the operating activities during the year. These will be things such as cash, inventory, land, buildings, equipment, things like that. Now liabilities, these are amounts that we owe to creditors, lenders. And so we need to know how much we owe. We need to know when it's due. So we'll have the cash to pay the creditors, the lenders off. Stockholders' equity. Now this is probably the most difficult section of this accounting equation to understand. This represents what the owners have invested in the business and also represents the earnings that have been retained in the company. Revenues, expenses, and dividends. Now, you probably know by now that profit equals revenues minus expenses. And so profit is often called net income, and this is when the revenues exceed expenses. Loss is when the expenses exceed the revenues. And of course, we hope we don't have losses, but sometimes we might have them for a couple of years, and hopefully things will turn around and then a profit will be generated after that. Revenues will be the sales we receive from the sale of products to customers or providing services to customers. The expenses will be the cost of running the business. Dividends, when the company decides that it has enough past profits and enough cash in the business, might distribute some of the profits to the stockholders. There are various business structures one can operate under. The simplest one is the sole proprietorship. This is a business owned by one person. It's a non-incorporated business owned by one person. A partnership is a non-incorporated business owned by at least two people. You could have thousands of partners, but you have to have at least two owners here. A corporation is a separate legal entity from its owners, the stockholders. A lot of people will decide to form the business as a corporation because of the limited liability it provides for the stockholders. Business activities. Now there are three main activities we'll cover throughout this semester. The first one, operating activities. These are the transactions that relate to the primary operations of the company. Investing activities. This relates to the purchase and sale of resources that provide benefits for several years, such as land, building, equipment, long-term investments, things like that. Then the third one, financial or financing activities. These are transactions the company has with investors, stockholders, the owners of the company, and creditors, the lenders. These three activities will be more apparent, and we'll cover them in more detail in the chapter later on about the statement of cash flows. Now, to communicate information through financial statements, we have four primary financial statements. The income statement is first. This reports the company's revenues and expenses over an interval of time. The time can be for a month, a quarter, 3 months, or for a full year. And as we talked about earlier, if the revenues for that period exceed the expenses, then we have net income. And then the opposite is true. If the revenues are less than expenses, then we have a net loss. So we need to remember that the income statement compares revenues and expenses for the current time period. And as I said, it can be a month or a year, or even a quarter. And this measures the company's profit or loss from running its operations during that period. Here is an example of an income statement. First, you list the revenues. Here we had service revenue of $7,200 for this golf academy. Then we have various expenses, and these are just some of the expenses the company might see: rent, supplies, salaries, and so forth. So once you subtract from total revenues your total expenses, then you will have your net income, as in this case, or it could be a net loss. Next, we have the statement of stockholders' equity. This is the bridge statement between the income statement and the balance sheet, and that'll become more apparent later on. It shows the changes in each of the stockholders' equity accounts from the beginning of the accounting period to the end of the accounting period. For example, the first period where the company first starts, we don't have any common stock outstanding. Nothing's been sold. But then we issued common stock. We, the corporation, issued common stock to the new owners, and therefore the ending balance in common stock in this case is $25,000. Retained earnings, this is an account that represents all the past profit and losses netted together over the prior years, less any dividends paid. Here, if this is the first year of operations, we don't have a balance in this account. But if we have net income of $1,200, that's added to the account. If we pay out dividends, we subtract that, and so we end up with $1,000 in this example. And then the far right column shows the total stockholders' equity accounts. The balance sheet. This shows where the assets will equal the liabilities of stockholders' equity, and those two sides must balance. They must equal each other at all times. Here's an example of a balance sheet. This is as of December 31st. On the left side, we have assets. So here are just a few, cash, accounts receivable, supplies, equipment, and other assets. On the right side, we start off with liabilities. List all the amounts that we owe other people, suppliers, utility companies, banks, or whomever. Then we have the stockholders' equity section, which will show the amount the owners have invested in the business in the form of common stock and the retained earnings that have remained in the business. So the two sides balance, $40,000 in total assets and $40,000 in total liabilities and stockholders' equity. Again, the assets must always at all times equal the total liabilities and stockholders' equity. Now, the statement of cash flows, don't worry about it too much at this point. We do have the three sections we will see in a later chapter, as explained earlier. Just note that it is the fourth statement of the primary financial statements, but don't worry about it at this point. This is sort of a busy slide, I know, but it is showing that net income from the income statement goes over into the second statement of stockholders' equity, and then the total stockholders' equity will go over to the balance sheet, as well as the common stock retained earnings account when you show a more detailed balance sheet. Then finally, the information from the balance sheet is used to prepare the statement of cash flows. For the first several chapters, we are going to concentrate just on the first three statements: the income statement, the statement of stockholders' equity, and the balance sheet. For the rules of financial accounting, investors, the owners, stockholders in the business, and creditors need to make decisions based on accounting information. As I mentioned earlier, do you want to purchase stock in a corporation? If you have a bank, do you want to loan the corporation, the company, some money? You need to look at their financial statements and see if they are producing good profits, do they have enough cash, and so forth. And so to do this, we need to use some kind of formal standards to present accounting information. These are called Generally Accepted Accounting Principles, and these are the standards we use in the U.S. So GAAP, yes, it's pronounced GAAP, G-A-A-P, and these are the main rules, standards used in financial accounting in the United States. Objectives of financial accounting. Okay, hopefully, the information we present will be useful to investors and creditors. They need to make appropriate decisions, so they need good information. It also helps predict cash flows. Do we have enough money to pay off the creditors, to the bank and so forth? Also, it shows the economic resources we have, claims, in other words, liabilities existing, and changes in the resources and the claims. Under GAAP, we have the economic entity concept, which means you need to record transactions only for that economic entity, that business. So the transactions are separate from the owner's personal transactions. The monetary unit, we have to have some measure to report the information, and so we're going to use the US dollar as the monetary unit to report the activity of the company. Periodicity, this means that we need to show the information for a time period. Again, is it for 1 month, 1 quarter, or for 1 year? And then finally, the going concern concept means that unless other information is given, we always assume that the company is a going concern. In other words, will be in existence next year and into the foreseeable future. So those are what I think are the most important concepts and information items in Chapter 1. So make sure you read the chapter in detail yourself, to pick up a lot more in detail. So good luck with your studies.